something strange is happening inside Indian households. On the surface, the story looks normal. India is growing and consumption is rising. More people are buying homes, phones, cars, appliances, two-wheelers, education, travel, and better lifestyles. But underneath that growth, another story is quietly building. A story of loans. Home loans, personal loans, credit card dues, gold loans, education loans, and microfinance loans are all part of it. App-based credit no-cost EMIs and buy now pay later services are adding to the picture. Informal borrowing that does not always show up in official numbers is also common. India is not just becoming a consumption economy. India is becoming an EMI economy. The most important question is not whether Indian households are borrowing, because they are. The real question is whether households are borrowing to build assets and future income, or borrowing to survive the present. Those are two very different stories. Let us start with the headline number. India's household debt reached roughly 40 to 43% of GDP in 2024 and 2025. The Reserve Bank of India's Financial Stability Report noted household debt at around 41.3% by the end of March 2025. That number means that for every 100 rupees of output, households now owe a little over 40 rupees in debt. Compared with the United States, Canada, or Australia, this is still not extremely high, but that comparison can be misleading. India is not an advanced economy with high incomes, deep safety nets, and fully measured formal credit systems. India has lower incomes, weaker buffers, and a large informal credit market that official statistics often do not capture. So a lower debt ratio can still be risky. The danger is in who is borrowing, why they are borrowing, what kind of loans they are taking, and whether incomes are growing fast enough to handle them. Indian household liabilities appear to be growing faster than disposable incomes and financial asset creation. Data suggests annual financial liabilities rose about 102% since 2019 to 2020, while financial asset additions rose only about 48%. That gap matters because debt is not automatically bad if it funds assets or emergencies, but rising liabilities faster than assets makes households fragile. A family may look fine in normal months until a job loss, health shock, failed business month, or urgent expense breaks the pattern. One missed payment can become two. Then a credit card balance turns into an EMI and another loan is taken to close the earlier loan. Household debt stress often begins slowly, with a loss of breathing room rather than a sudden crash. When people hear household debt, they often assume it is mostly home loans. Housing loans still form a large part of borrowing and are often seen as good debt because they link to an asset. But incremental growth has increasingly come from non-housing retail loans like personal loans and credit card loans. That shift means India is borrowing more to consume and less to build enduring assets. A smartphone EMI creates a liability while the phone depreciates, and a credit card purchase is already gone. A gold loan pledges a family's safety asset and elevates cash flow pressure. When non-housing credit grows faster than housing credit, the debt story becomes less about asset creation and more about cash flow pressure. The Indian middle class is often described as stable, aspirational, and upwardly mobile. And in many ways that is true, but there is another version of the middle class story. A salaried couple in a tier 2 city may have a home loan, a car EMI, a phone EMI, a credit card balance converted into EMI, and maybe a gold loan taken for a medical expense or family emergency. The income is there, the lifestyle is there. The credit score may be good, but the monthly surplus is thin. The household is not poor, but it is fragile. This is the middle class squeeze, not absolute poverty, but a life where fixed monthly obligations keep rising faster than financial buffers. Per capita borrowing has also risen among prime borrowers. That can be interpreted positively. It shows greater credit access. It shows formalization. It shows that lenders trust more Indian households. But it also means that even financially stronger borrowers are carrying more obligations every month, And when more of your salary is pre-committed to EMIs, you have less room to absorb shocks. This is how a confident consumer economy can slowly become a leveraged consumer economy. The rise of the EMI economy. The EMI has become one of the most powerful financial inventions in modern India. It has changed the way people buy. A phone that once looked expensive now looks affordable. A refrigerator becomes a monthly payment. A two-wheeler becomes a manageable deduction. A holiday becomes a card conversion. A coaching course becomes a financing plan. The EMI makes the present feel affordable by spreading the cost into the future. And for many families, that is genuinely useful. It allows smoother consumption. It helps people access products earlier. It can improve quality of life. But it also changes psychology. When everything is converted into a monthly payment, the real cost becomes harder to feel. The question shifts from, can I afford this purchase, to, can I afford this month's EMI? That is a very different question. Industry surveys show widespread use of EMI cards and purchase-led credit. Home Credit's How India Borrows study reported strong preference for EMI cards among borrowers. Phones, appliances, two-wheelers, education, and travel have all become part of this financialized consumption pattern. This does not mean every EMI is dangerous, but when EMIs multiply across categories, the household budget becomes a stack of promises made to the future. And the future has to pay for all of them. The unsecured credit boom. The most important risk area is unsecured credit. Unsecured loans do not require collateral. That includes many personal loans, credit card loans, and app-based consumer loans. After 2021, unsecured personal loans and credit card balances surged. Credit card outstanding amounts more than doubled between mid-2021 and mid-2025, according to reporting based on Reserve Bank of India and industry data. This growth became large enough for the Reserve Bank of India to intervene. In 2023, the RBI tightened supervisory policy and increased risk weights on certain unsecured exposures. In simple language, it told lenders that this kind of lending was becoming risky enough that they needed to hold more capital against it. That was not a ban, it was a warning. The central bank was saying growth is fine, but uncontrolled unsecured credit growth can become dangerous. And the problem with unsecured credit is that it can grow very fast. No collateral check, quick approval, digital onboarding, instant disbursement, small ticket loans, repeat borrowing. From the borrower's point of view, it feels convenient. From the system's point of view, it can become a hidden stress machine. Credit cards as silent stress. Credit cards are one of the most silent forms of household debt stress. They look normal because they are everywhere. They are marketed as rewards, convenience, lifestyle, cashback, lounge access, and smart spending. But underneath that convenience is one of the highest cost borrowing products available to ordinary consumers. If you pay the full bill every month, a credit card can be useful. But if you roll over balances, pay only the minimum, convert purchases into EMIs or miss payments, the cost can compound very quickly. The report notes that credit card dues have grown sharply since 2021. Some reporting suggests dues grew about 2.2 times in 4 years. There has also been a rise in overdue amounts and stress in deeper delinquency buckets. This matters because credit card stress often remains hidden until it becomes serious. A household may not call itself indebted. It may say we just have card payments, but a card balance is debt. A converted EMI is debt. A minimum payment trap is debt. Late fees are debt pressure. And when credit cards become a bridge between income and aspiration, they become a signal that monthly earnings are not matching monthly consumption. Gold loans and distress borrowing. Gold has always been different in India. It is not just an investment, it is savings, security, culture, marriage wealth, emergency insurance, family memory. That is why the rise of gold loans deserves special attention. Gold loans are secured loans. The borrower pledges gold and receives money against it. In theory, that makes gold loans safer for lenders. But for households, the story is more emotional and more revealing. When a family pledges gold, it often means they need liquidity urgently. It may be for a medical bill, a business cash flow problem, a school fee, a wedding expense, a farm shock, a loan repayment, or simply a month where income did not cover expenses. Gold loan assets under management have expanded rapidly across banks and non banking financial companies. Industry estimates from rating agencies and market reports suggest the organized gold loan market could expand to multiple lakh crore rupee levels by mid decade. Part of this growth is formalization. That is good. But part of it may also be distress borrowing. And rising gold prices add another layer. When gold prices rise, households can borrow more against the same jewelry. That can improve liquidity, but it can also encourage higher leverage against a family's last resort asset. So gold loans are not automatically bad, but they are often a signal that many households are turning family wealth into working capital for survival. Rural India and urban India are not borrowing the same way. India's household debt story is not uniform. Urban salaried households may use credit cards, personal loans, consumer durable loans, and home loans. Rural households may rely on gold loans, microfinance, informal lenders, farm credit, shopkeeper credit, or borrowing from relatives. Some richer and southern states show higher formal indebtedness. States like Andhra Pradesh, Telangana, Kerala, and Tamil Nadu often appear with higher incidence of indebtedness in survey-based analysis. But that does not automatically mean they are poorer or more distressed. It can also mean formal credit access is deeper. In poorer states, the problem may be less visible because borrowing happens informally. Money lenders, shopkeepers, chit funds, local networks, family and community loans. These debts may not show up fully in formal banking data. So the real Indian household debt story is partly visible and partly hidden. Formal credit tells one story, informal credit tells another, and the most vulnerable households often live between the two. There is also a gendered side to household debt. Microfinance and self-help group lending channels have large female borrower bases. In many cases, these models have helped women access credit, build income activity, and enter the formal financial system. That is the positive story. But there is also a darker side. Investigations and civil society reports have documented cases of over-indebtedness, pressure, and harassment in some lending contexts. When household debt is taken in a woman's name, the social and emotional burden can fall heavily on her, even if the loan benefits the entire family. This is especially important in microfinance. A woman may be the borrower on paper, but the money may be used for household expenses, husband's business needs, children's education, medical costs, or old debt repayment. If repayment becomes difficult, she may face collection pressure, social embarrassment, and family stress. So debt is not only a financial number, it can also become a social burden. Microfinance is one of the most important parts of India's financial inclusion story. It has brought formal credit to people who were ignored by banks. But in recent years, stress has risen in parts of the sector. Reserve Bank of India and press reports flagged rising microfinance delinquencies in 2024. Some stress buckets reportedly worsened during 2024, and there has been concern about multi-lender borrowing among vulnerable borrowers. Multi-lender borrowing means the same borrower takes loans from several lenders. This can look fine for a while. One loan repays another. A new loan covers the old EMI. But eventually, the borrower's actual income cannot support the total repayment burden. That is when microfinance changes from inclusion to overleverage. Again, the nuance matters. Microfinance is not the villain. Without it, many households would be pushed toward moneylenders. But without careful underwriting, borrower level checks, and protection from aggressive recovery, microfinance can also deepen distress. India has made huge progress in bank account penetration and digital finance. But informal debt remains deeply important. Many low-income households still borrow from local lenders, shopkeepers, relatives, employers, and community networks. Why? Because formal credit still has barriers: documentation, credit scores, stable income proof, collateral, digital comfort, bank branch access, past repayment history. A person who cannot get a bank loan still needs money when a child is sick, a crop fails, a shop needs inventory, or rent is due. So they borrow informally, sometimes at high cost, sometimes with social pressure, sometimes with little transparency. This is one of the biggest data gaps in India's household debt story. The formal system may say debt is manageable, but informal debt may be hiding stress that official dashboards do not fully capture. There is a macroeconomic side to this story. Household credit has supported India's post-pandemic consumption recovery. When people borrow, they spend. When they spend, companies sell. When companies sell, economic growth looks stronger. This is not unique to India. Credit-driven consumption is a common part of modern economies, but it has a trade-off. Borrowing today pulls future consumption into the present. A phone bought today on EMI reduces future monthly income. A holiday financed on credit reduces future flexibility. A personal loan used for consumption becomes a fixed future obligation. So credit can boost growth in the short run, but it can weaken household resilience in the long run. That is the core tension. India wants consumption growth, lenders want retail credit growth, consumers want better lifestyles. But if too much consumption is financed by debt rather than income growth, the system becomes vulnerable. A major part of the household debt debate is about savings. India has historically been known as a high savings society, but net household financial savings fell to multi-year lows in financial year 2023 and financial year 2024 before showing some improvement in certain later periods. This triggered concern. Are Indian households saving less because they are stressed, or are they simply moving money into real estate, gold, and market-linked instruments? The answer appears to be both. Some of the decline reflects a shift in asset allocation. Households may be putting more into housing, gold, mutual funds, equities, or insurance products. But part of the concern is real. Once rising liabilities are netted out, household financial savings look weaker. This is important because savings are the shock absorber of a household. Savings protect against job loss. Savings protect against medical emergencies. Savings protect against school fees, repairs, weddings, and business shocks. When debt rises and savings shrink, the household becomes less resilient. There is also a generational shift. Young Indians, especially Gen Z and millennials, are more comfortable with EMIs, app-based credit, and digital borrowing. Earlier generations often treated debt with caution. You saved first, then bought. You avoided loans unless necessary. You feared default. You prized debt-free living. Younger consumers are growing up in a different financial environment. Credit is embedded into apps. EMIs are presented at checkout. No cost EMI makes borrowing feel free. Buy now, pay later makes payment feel delayed rather than borrowed. Credit scores turn borrowing into a game of access. Lifestyle pressure is visible every day through social media. This does not mean young people are irresponsible. Many are simply operating in a system designed to make credit frictionless. But frictionless credit changes behavior. When borrowing becomes invisible, debt becomes easier to normalize. Not all debt is consumption debt. Education loans are a form of aspiration debt. They are used to invest in future earning power. Education loan outstanding at banks reportedly reached around 1.3 lakh crore rupees by late 2024. This includes loans for domestic education and overseas study. In principle, education loans can be productive. If the education leads to better income, the loan can make sense. But aspiration debt also carries risk. If fees rise, job markets weaken, salaries disappoint, or overseas employment becomes harder, the household can be left with a long repayment burden. So, education loans sit in a gray zone. They are not like credit card lifestyle debt, but they are also not risk free. They are a bet on future income. Medical debt is one of the most painful forms of borrowing. It is usually not planned, it is not aspirational, it is not about lifestyle, it is about survival. India still has significant out of pocket healthcare spending. Even with insurance expansion, many families face expenses that exceed their liquid savings. When that happens, they borrow. They sell assets, they pledge gold, they ask relatives, they take personal loans, they delay other payments. Medical debt is important because it reveals the weakness of household buffers. A household can look financially stable until one hospital bill changes everything. Unlike a consumer purchase, medical debt is not discretionary. You cannot postpone an emergency surgery because the monthly budget is tight. Then there is wedding debt. Weddings remain one of the biggest culturally driven expenses in India. For many families, a wedding is not just an event. It is status, obligation, emotion, family honor, and social performance. That creates pressure to spend beyond comfortable limits. Media and consumer finance reporting has documented wedding loans and EMI based financing for ceremonies. This type of debt is often non productive. It does not build an income generating asset. It does not necessarily improve future earning power, but it can create years of repayment pressure. Wedding debt shows how household finance in India cannot be understood through economics alone. Culture matters, status matters, family expectations matter, and debt often enters through those emotional doors. Small business and household debt overlap. Another complication is the overlap between household debt and small business debt. In India, the household and the enterprise are often not separate. A shopkeeper may borrow personally to fund inventory. A farmer may borrow against household assets for cultivation. A family may take a gold loan to keep a small business running. A personal loan may actually finance a microenterprise. So when we say household debt, some of it may be productive business borrowing. That is an important caveat. Not every personal loan is used for consumption. Some household loans are really working capital. But this overlap also creates risk. If the business fails, the household suffers. If household expenses rise, the business is starved. If one loan is used to support both, repayment stress spreads across the family's entire financial life. India is also entering the credit score economy. More consumers are monitoring credit scores. Lenders use scores to decide access and pricing. A good score can unlock cheaper credit. A weak score can push borrowers toward expensive loans or informal lending. This creates a new class divide. People with salaried jobs and strong credit history get better credit. People without those advantages get costlier credit or no formal loan at all. So the credit system can become self-reinforcing. The already stable borrower gets cheaper money. The vulnerable borrower pays more. And when credit becomes essential for mobility, exclusion from good credit becomes a serious disadvantage. Fintech has changed the speed of borrowing. Digital lending reduced friction. Loan discovery, approval, documentation, dispersal, and repayment all became faster. This helped expand credit access, but it also accelerated unsecured growth. When credit becomes fast, lenders must become more careful. The Reserve Bank of India has introduced digital lending directions and tightened supervision in recent years. These steps are meant to improve transparency, consumer protection, and responsible lending. But regulation is always playing catch-up with product innovation. By the time a risky lending pattern becomes visible, millions of small loans may already exist. That is why fintech credit is powerful but delicate. It can democratize finance, or it can industrialize over borrowing. Different lenders play different roles. Banks have large balance sheets and regulatory oversight. Non-banking financial companies often specialize in retail, gold loans, vehicle loans, and consumer finance. Fintechs reduce acquisition friction and bring app-based distribution. Together, they have expanded India's retail credit machine. But this also means risk can move across the system. If banks slow unsecured lending, borrowers may shift to non-banking lenders. If non-banking lenders tighten, borrowers may shift to gold loans. If formal credit tightens too much, vulnerable households may move back to informal lenders. So policy cannot simply crush credit growth, it has to guide it. The RBI's balancing act is to protect the system without shutting off credit access. That is not easy. Too much credit creates risk. Too little credit creates exclusion. The Reserve Bank of India has repeatedly signaled concern about rapid retail credit growth, but it has also generally viewed overall system risk as contained. That distinction matters. The RBI is not saying India is facing a household debt crisis. It is saying that there are pockets of vulnerability. Unsecured retail loans can be a concern. Credit card delinquencies are another watch area. Microfinance stress is also being monitored. Gold loan growth is on the radar. Multi-lender borrowing is a risk too. The RBI's tools include higher risk weights and supervisory guidance. Board-approved exposure limits and digital lending rules are also used. The aim is to slow excess without damaging financial inclusion. This is a difficult balance because credit is both a growth tool and a risk channel. If household debt is rising so much, why have defaults not exploded? First, a large share of debt growth is concentrated among prime and above borrowers. These borrowers have better repayment capacity. Second, some stress may be hidden through rollovers and EMI conversions. A borrower may not default because they convert one balance into another loan. Third, family support plays a major role in India. Relatives often help prevent formal default. Fourth, gold loans can provide emergency liquidity. Fifth, some informal borrowing may absorb stress before formal defaults appear. So low aggregate delinquency does not mean there is no stress. It may mean stress is being managed, shifted, refinanced, or hidden. But early warning signs exist. Credit card delinquencies have risen in certain buckets. Microfinance stress has increased in some periods. Households with thin savings are more vulnerable to shocks. India's household debt to gross domestic product ratio is lower than many advanced economies. That sounds comforting, but it needs context. A household in a rich country may carry high debt but also have higher income and deeper insurance. They also often have unemployment support pension systems and more formal financial protection. An Indian household may carry lower debt but have lower income and higher medical vulnerability. They often face more informal obligations and weaker safety nets. So the same debt ratio does not mean the same risk. India's risk is not only macro leverage, it is household fragility. The problem may not be that India has too much debt by global standards. The problem may be that many Indian households have too little buffer for the debt they already carry. Debt also varies by state. Some southern states show higher formal indebtedness. This can reflect better access to banks' microfinance gold loans, housing finance, and formal institutions. But high indebtedness can mean different things in different places. In one state, it may indicate productive borrowing and financial inclusion. In another, it may indicate distress. In poorer states, lower formal debt may not mean lower debt stress. It may simply mean more informal borrowing. A regional debt map has to be read carefully. The visible debt may be formal, and the invisible debt may be informal. The real risk lies in the combination. One of the most interesting parts of this story is the class divide. Debt growth is not evenly distributed. Higher-rated borrowers have seen larger absolute increases in borrowing. This can make the system look safer because prime borrowers usually default less. At the same time, weaker borrowers may face scarcer or costlier credit and informal borrowing. So the headline number hides two Indias. 1. India has access to formal loans, better rates, credit cards, home loans, and EMI products. The other, India borrows from microfinance gold lenders, money lenders, shopkeepers, relatives, or app-based lenders at higher effective costs. Both are indebted, but their terms are different. In debt, terms matter as much as the amount. In the new credit economy, asset owners have an advantage. If you own property, you can access secured loans. And if you have gold, you can pledge it. If you have a salaried job, lenders trust your income. If you have a strong credit score, you get better pricing. If you have none of these, credit becomes expensive or unavailable. This creates a financial hierarchy where the wealthy borrow cheaply, the vulnerable borrow expensively. The middle class borrows easily, but may become EMI trapped. The poor may be pushed between microfinance and informal debt. India's household debt story is not only about borrowing, it is about unequal access to good borrowing. A useful way to understand this story is to separate good debt from bad debt. Good debt can fund a home quality education or a business that generates income. Bad debt often funds lifestyle credit impulse consumption or no-cost EMIs that encourage overspending. Borrowing for status expenses can weaken household finances without building future capacity. The danger is when bad debt grows quietly inside a society that still believes it is only using credit smartly. The EMI does not feel like debt when the product is new. It starts feeling like debt when the next EMI is due. So is India facing a household debt crisis, not yet based on the report. The official view appears to be that the risk is contained. But contained does not mean irrelevant. The vulnerabilities are clear. Unsecured credit has grown rapidly. Credit card stress is rising in some areas. Microfinance has shown stress pockets. Gold loans may be partly substituting for other forms of distress borrowing. Informal debt remains undermeasured. Savings buffers have weakened. Many households are increasingly dependent on regular income to service fixed obligations. This is not a sudden collapse story. It is a slow vulnerability story that builds during good times and gets tested when conditions change. Debt in India is also political. Farm loan waivers, election promises, and ad hoc relief measures affect borrower behavior and lender expectations. When debt relief becomes political, it can help distressed borrowers, but it can also create moral hazard. Borrowers may expect future waivers, lenders may price risk differently. Governments may use debt relief as an electoral tool. This makes household and farm debt not just a financial issue, but a political economy issue. Who gets relief? Who pays for it? Who is excluded? And how does it change the culture of repayment? These questions matter because debt is not only a private contract. In India, it often becomes a public debate. Imagine a salaried couple in a Tier 2 Indian city. They own a small apartment with a home loan. They have a car EMI. One phone is on EMI. A credit card balance was converted into monthly installments. A gold loan was taken after a medical emergency. A small business top-up loan helped a family member keep a shop running. On paper, this household is middle class. It has assets. It has access to formal credit. It has income. It may even have a decent credit score. But every month, most of the income is already spoken for. The household is not collapsing, but it is walking on a narrow bridge. One job loss, one hospital bill, one business shock, or one major family expense can force another round of borrowing. That is the real meaning of the EMI economy. Not that everyone is in crisis, but that more households are living with less margin for error. The big thesis: India's economy is shifting toward a higher credit EMI-centric consumption model. This model has benefits. It expands access, it supports consumption, it helps people buy homes, vehicles, phones, appliances, education, and services. It brings more households into the formal financial system, but it also has costs. It pulls future consumption into the present, it reduces precautionary buffers, it increases sensitivity to income shocks. It makes households dependent on smooth monthly cash flow. And it can hide stress behind refinancing, EMI conversions, gold loans, and informal borrowing. The key point is not that Indian households should never borrow. That would be unrealistic and even harmful. The key point is that borrowing quality matters. Debt that builds future capacity is different from debt that only funds present consumption. Credit inclusion is different from credit dependence, and financial access is different from financial resilience. What policymakers need to watch. The policy challenge is delicate. India needs credit access. Millions of households and small businesses still need better formal finance. If formal bill lenders pull back too much, vulnerable borrowers may return to moneylenders and informal debt. But if lenders push too aggressively, households can become overleveraged. So policy has to do several things at once. It has to monitor unsecured credit, it has to improve transparency in app-based lending and EMI conversions, it has to protect borrowers from hidden costs and aggressive recovery. It has to watch gold loan exposures and loan to value risks. It has to track microfinance multi-lender borrowing. It has to improve borrower level data. And it has to encourage savings, not just borrowing. Because a healthy household balance sheet needs both sides, access to credit and the ability to survive without constantly using it. The final question, the great Indian household debt story, is not a simple story of danger. It is also not a simple story of progress. It is both. It is the story of a country becoming more financially included, more aspirational, and more consumption driven. But it is also the story of households taking on more fixed obligations in a world where incomes, healthcare costs, jobs, and social expectations remain uncertain. India's growth story may increasingly depend on the Indian consumer, but the Indian consumer is increasingly depending on debt. That is the tension. The next phase of India's economy will not only be decided by gross domestic product growth, stock market performance, or corporate earnings, it will also be decided inside ordinary households, at the kitchen table, during salary week, when the EMI message arrives, when the card bill is due, when the gold is pledged, when the next loan offer appears on a phone screen. India is not just building a consumption economy, it is building an EMI economy. And whether that becomes a ladder of opportunity or a trap of overborrowing will depend on one thing: whether debt helps Indian households build the future, or whether it quietly steals that future one monthly payment at a time.